Hey guys, thanks for joining us today. We have got Barb Legerre in the house. She's here to talk about interest rates from what we saw during COVID times all the way up to present day. And we're going to make sense of some of the numbers for you guys in terms of terminology. But we're also going to work through what a mortgage would be 800,000, what a mortgage would be at $1 million or 1.5, how much down you have to be. So I hope you guys enjoy. I hope you get some gold nuggets from this one, and we're going to get started. So Barbara Legerre is almost 20 years into the industry, started with Scotiabank, and now you're a broker on your own, correct?
Technically a mortgage agent.
Okay.
Technically.
Terminology. We talked about terminology. So tell us, Barb. So let's just get a little background on yourself. Okay. So how you got into the business, what you were doing before, where you're from, and then we'll get up to present day.
So way back, like 2007, how I got into the business. So I was looking for a change. You're
old.
I am old, yes. I was looking for a change. So I've always been in sales, from the moment I graduated university.
Yeah.
Just different types of sales. So transportation, automotive fleet, marketing, fulfillment, and then I don't know how it all. I was always interested in finance, and I used to do automotive credit as one of my careers. So you can have multiple careers in a long life.
Yeah.
And so I'm a perfect example of that. And I just was looking on the internet and had seen this position listed at Scotiabank, and I thought I will submit my resume, and basically the rest is history.
That's it.
So when I started from ground zero. Other than I had excellent financial background.
Okay. Mm-hmm. So then when you first started, you were in-house, or you were a mobile specialist?
Always mobile.
Always.
I was never part of the branch.
So what's the difference between mobile and branch or in-house?
So a branch, you're even in the bank. So there's two types of employees. So there's branch salaried. Yeah. You have hourly staff as well, frontline staff that are in the branch, but they're domiciled to a branch. Whereas a mobile mortgage specialist, or we were called MDMs, or home financing advisors, they would have much more freedom. The ad space was 24/7. I don't think we ever actually expect to do a mortgage at 1:00 in the morning, but you could. So you're completely mobile. You have your own laptop. Everything's really huge on privacy and security. So I'd stress that, because that's carried me forward even to the broker world. Yeah. The privacy and security, making sure, even in my office now, I make sure the door is locked, then the cabinets are locked. Where the files are, and eventually, they're shredded. But that's huge. Privacy and security for confidential information is big. But at the bank, that is even bigger. And you are always taking courses and having to upgrade financial security, AML, which is anti-money laundering, a lot to do with fraud, because mortgage fraud is huge. And and Ontario is one of the largest homes for mortgage fraud.
Really?
Meaning it's quite significant in Ontario.
Yeah?
Specifically in Brampton.
So what are the Brampton's had top of car thefts too, I think, too,
yeah,
right?
So
okay, so in terms of, let's just talk about that for a second. Mm-hmm. What kind of mortgage fraud are you seeing right now? What's a scheme that you've seen recently?
I don't really see schemes myself, because most of my business comes from referrals, or known entities. So I know them. Okay. I know where they come from. I know how the referral was sourced. If someone were to call me off the internet, I would ask further questions, further probing, like, how did you get my name? But normally someone will introduce themselves as, I'm so-and-so. I got your name from Tyler Dawe. He suggested I give you a call. Yeah. Sometimes it's a second opinion. Could work that out. But so it really depends on the clientele. But I can tell you that in mortgage fraud itself, a lot of it is fake paper. I don't want to educate people on how to do it.
I want them to hear because I was always under the impression with mortgage fraud that you need a mortgage broker, you need a realtor, you need a lawyer, you need a few different hands in order to or an appraiser over appraise the price, and but is there anything that you've seen or heard of in the last little while that people are doing?
So fake accounts, right? Doctoring account statements.
Okay.
Right, because any down payment we have to verify, and it has to be typically verified with 90-day history.
Okay.
And source of deposit, if it's significant or irregular, we have to flag it. So we look diligently on that because the lender is going to look diligently on that.
Yeah.
So, for example, if something doesn't make sense, so pay stubs, one of the easiest, maybe not so much ADP, the prepared, but maybe a small company, a lot easier. So it depends,
so people will fudge a pay stub.
Well,
or
fudge
even
a
bank account.
They can fudge a bank account, right? But then there's ways of figuring it out, right? Sometimes it doesn't always get caught, but usually does.
Wow.
Right? So, if, not to say that every home operation, but if you've got a large company with an internet presence, but the income is coming from a residential address, that's a red flag. Not to say that you can't work from home.
Yeah.
Or that small companies don't exist. It just takes extra due diligence to make sure that that's, if that is the deal.
You send it away to see if it's acceptable or not.
So I think it's, and let's not even use a mortgage example. Let's just use a tenant example.
Yeah.
Like if you're a landlord and you're looking, for a good tenant, and you want to make sure that they pay and that they have the resources to maintain the rent, right? So even for something as simple as that, you would want to know that they, not big on NSF, so you'd want to make sure that the letter from the bank was authentic, stamped. You would want to make sure that the income could support the rent, right, and it's legitimate. And you want to make sure that it checks out. So even as a landlord, I would Google the employer to make sure it's a legit employer, right? Yeah. Is the address make sense? Is the phone number, cross-reference it? Do they have a LinkedIn profile? Anybody can have a LinkedIn profile. Yeah. However, if the person on the HR letter has a LinkedIn profile, or you can see them on the company website, that gives you comfort level that this is authentic.
That's authentic. Yeah, because I always look at that and some of those guys that do the mortgage fraud or any type of fraud is the intricacies of it. It's really, sometimes it's really smart, and you're like, geez, if they put their time into doing something that was legal, these guys would make a lot of money, know? So then in terms of rates, can you kind of give us a bit of a background to, and you and I were talking earlier just about as a realtor, we would always kind of default to you guys in terms of rates and lending. And I've never remembered focusing on rates that much. And I've been selling now, I'm on my 16th year. Because they were always kind of floating around, whether it was, in 3.5, but they never fluctuated that much as we've seen in recent years. So just give us an idea, let's talk about that, because it's the topic of everybody's talking about interest rates. Interest rates come down, property values are going up. And we know that if they're too low, COVID really taught us that the property value goes to a point where it's unsustainable. So how do we keep this equilibrium, so to speak?
So it's all economically driven. And there's actually distinctively two types of rates. They're the variable rate, which is set by the Bank of Canada, but the Bank of Canada sets the overnight rate. Okay. And that's basically what lending institutions can borrow money for. Okay. And so the current Bank of Canada rate as of today, because they paused last Wednesday, is 2.75. And so someone might be asking, why is that not the rate that the bank is offering? The bank charges a premium on that. So the bank prime rate across the board, I don't think any lender is not doing so, is 4.95% as of today.
So let me just go back. So the overnight rate or the bank rate, one and the same, correct?
Yep.
That is 2.75.
That's for the Bank of Canada.
Yeah. And then the bank is lending that money out at 4.95.
Not necessarily. 4.95 is their prime rate.
Okay.
So they can, for a variable rate mortgage or a line of credit, because a line of credit is open, but it fluctuates as well. Most lines of credit are prime. Okay. You can get them. A little bit difficult. It depends on the profile of the client. But on average, it's prime plus a half.
Okay.
So that, in fact, that client is that's 5.45% for that money.
So prime plus.
Prime plus.
Have you seen now? Have you ever seen prime minus?
On a line of credit?
No, on a mortgage.
Oh, all the time.
Okay.
Okay, so the key on a variable rate mortgage is that discount.
Okay.
So when someone says prime minus, there's a difference between prime minus 20 and prime minus 1 and prime minus 90. It's the discount off of prime that carries with that mortgage term. Okay. So that in itself is the contract. Okay. And so that rate, so let's work with, right now the average I'd say is prime minus 60. Okay. And the reason for that,
when you say 60, what do you mean?
60 basis points discount off of prime. So the reason for that is credit spreads have thinned. So it's a little more costly for banks to lend out that money at a greater discount. Okay. So whereas in December, you could easily get a variable rate mortgage at prime minus 80. Okay. So that is a much better discount than prime minus 60.
But prime's down though now.
Prime's down, right? But the discount is what one should measure. Okay. And the reason for that is because that if prime continues to drop, which I think we're going to get a couple more drops this year, though I think we're at the end of the tightening cycle. Yeah. Unless something catastrophic happens, I think we're almost there. Okay. Like it's pretty balanced. So that prime, so I can foresee it, that rate going into the threes. Because if you have prime minus 90, let's say right now, you are paying 4.05 on that mortgage. Okay. Right. And so that's the important part is the discount, because you want to make sure, because if conversely variable was to increase, which it could, like if inflation comes back in and maybe if it's persistent. So right now they're projecting that inflation is going to tick up a little bit, but it's not going to be persistent.
So you won't see that. You don't think you're going to see that in the rates.
Correct.
Right. Because if inflation goes up, then the rates are going to go up with it, correct?
Correct. But if it's persistent. So if you recall during COVID times, we had really low variable rate mortgages. You could get prime minus 1 or prime minus 1.10, not a problem.
What was the lowest actual mortgage rate that you got during that time?
I would say 1.45. You may have got the odd person that was prime minus 1.1, which would have been 1.35.
Wow. Okay.
So think about that. And when prime got as high, I think it's 200 basis points down right now. So prime got as high as almost 7%. Yeah. Right. In 2023 was the highest.
7%.
Mm-hmm. Let's say it wasn't, but let's just for round numbers.
Yeah, it was just shy.
Right. So even if you had prime minus 1, you're paying 6%.
That's right.
Right. So think about that scale and jump in payment from 1.35. If you had a discount of 1, is 6%. That's huge. Yeah. It's a lot. It's more than double.
Well, and I appreciate you going through that, because like even for me, I'm always you're like I get confused. I'm like, how many times have I phoned you? And I'm like, hey, what do you mean prime? Like bank rates and prime rates and all this stuff. Like people, like even during that time, people would see 6.95. I think that was the highest, right, or something like that. And then they would be like, okay, rates are almost 7%, but there still was the discount, right? And a lot of people kind of forget about that discount, right? And that's why you're saying that even if you phone a bank and they tell you this is the prime rate, you still want to know what their discount is.
Correct. That's the key.
Okay. And then the discount is, can you get a lower discount? Or more of a discount if you have better credit, or if you have more money down, or anything like that?
I wouldn't say it's really on money down. Sometimes you would get a bit better discount if you have a larger mortgage. I know that's like opposite thinking, but there's more spread in that mortgage, so you potentially may get a better discount for a larger mortgage. There's a little more spread there, but it's not going to be significant, right? So so it just depends on the credit spreads and what they can lend it out for at that point in time. Okay.
So and then just to recap for everybody out there, the overnight rate isn't what you're going to purchase and finance a house with, right?
Correct.
So 2.75 is the overnight rate, but the banks are 4.95 less the discount.
Correct.
Correct.
And then the other with a variable rate mortgage is they're not all created equal. So I don't want to get into the weeds of the nitty gritty, but it's important. So you have variable rate mortgages, which the payment is static. So for example, you have a variable rate mortgage today. You have prime minus 60. Let's say the payment works out to $2,000.
Okay.
Prime reduces. Your payment is still going to be $2,000. Prime goes up. Your payment is still going to be $2,000. What happens is if prime were to reduce, the proportion of interest is going to be less if the rate goes down compared to principal. And if the rate goes up, you're going to be paying less in principal. Now, what you have to be careful of with the static payment is that if rates go up like they did in 2023 and they hit the lender's trigger rate, and each lender specify what that is in the fine print, and nobody's bothered to read it because it was never a factor up until 2023, then
it goes up.
They will increase the payment because at that point you're upside down in your mortgage, meaning when that trigger rate hits, you're no longer paying any principal. So what happened to those clients that were in that type of payment, that interest or that lack of principal was capitalized, was tacked on to the end of the mortgage, which effectively extended their amortization.
Okay. So let me clarify. It's a static mortgage. Is that what you'd call it?
Static payment.
Static payment. Now, that's not on any variable rate. That's certain lenders will offer a static payment.
Right. So certain lenders have static payments. That's all they offer.
Okay. So for you guys out there that don't understand that, right, you have your interest and your principal, right? And then you've got your payment. So Barbara, this particular case was $2,000 a month, right? If the interest rate goes up, the only thing that changes is how much you're paying off principal. You're just paying more interest. Is that correct?
If the interest rate goes up, yes.
Okay, and if it goes down, do you pay more principal?
You pay more principal.
Okay, so it's a double-edged sword that way. But if it gets to a point where the interest rate goes so high, in the case of what happened in 2022, then you hit your, what did you call that?
A trigger rate.
Your trigger rate. And the trigger rate meant that your payments would go up, correct?
Your payments would be whatever the bank has determined will right size you, whatever that is.
What you could afford.
No, not necessarily what you can afford. What right sizes it for that mortgage. So in some cases, it was a hardship, right? For some. So think about it. Their payment may have gone up $1,500 or $2,000 a month. So think about that in a monthly.
When you say hardship, though, like you mean someone's lost their house? Not
necessarily lost their house, hopefully not, but really constrained their budget, or may have forced them to sell their house. It could have cascaded that.
And like in theory too, that static payment to me makes sense because then you can guarantee that the payment's going to be the same throughout. And then if it does fluctuate minimally, right, then it's, sometimes it's higher interest, sometimes it's higher principal. In theory.
So
right?
There's advantages and disadvantages to both, right? I much prefer the variable rate mortgage where the payment adjusts with prime.
Okay, but then with the and I guess because it's going to go up anyways, right?
Eventually. Maybe not in minimal rate moves. It's not going to make such a difference.
Yeah.
But think about it from the perspective of when it's 200 basis points.
Yeah.
And then, yes, you are paying more, but it's gradual. But then also on the way down, you're also experiencing a lesser payment, right? And if someone enjoys paying that higher amount, right, when their rate was adjusted or the adjustable rate, then if they want to continue and their mortgage contract allows to pay that mortgage to keep the payment the same and further accelerate their amortization and pay more in principal than interest, to me, that's a better option, financially better for them.
Do you have the option to do that?
It depends on the lender. So not all lenders have that. Okay. With every lender, you have prepayment privileges, right? So if a static, in 2023,
still talking variable rate.
Still talking variable.
Okay.
In a static payment, the $2,000 example, if that rate, for example, in 2023, I was able to get for clients prime minus 90.
Okay.
on a regular basis. And their payments were set at that high rate of 6.9, so 6%. So now it's come down a significant amount. They're still paying that $2,000, but their principal now is being hammered away because of the proportion of interest to principal, because prime has significantly dropped. So for them, they're at a financial advantage in terms of equity and principal.
It's kind of one of those, it's kind of like that thing where like you make one extra payment a year, right?
Except they're doing it every time.
Every time. So, okay. So then I guess too, it's nice for everybody out there that's listening, is that there's like when people look at mortgages, or when they talk to someone like me about mortgages, it's pretty standard. It's variable rate, it's fixed rate. Is it a 25-year amortization? Is it a 30-year? Are they putting 25% or 5% or 25%? Is it insured or uninsured? But for you, there's more. Like, it's not just about getting the best rate, because sometimes getting the best rate can put you in a static payment in a particular time, which might be at a disadvantage for you. Right.
It's education. So you want to make sure that that client's comfortable with what the product that they're in, right?
Yeah.
And is it a means to be in the house, right? And you get your feet wet at first, especially if it's your first home. Most first-time buyers probably aren't really comfortable with a variable. They may be, but you got to talk about the good and the bad with it, because there is good and bad with everything. There's great advantages with a variable. It's far more flexible than anything else. We can talk about that whole penalty situation, which is going to come back into play. It's quite exciting.
Yes. Because your business strikes me as like, you can see it online. You think someone can get 5.25%, and then all of a sudden you see an ad that says 4.99%. And so you get a lot of people that chase, basis point movements, right? Like, how do you deal with that?
It's difficult because rate is still important, and that is the easiest number to understand in a mortgage, right?
Yeah.
Think about it as, because everybody likes the price of eggs. It seems to be the buzzword.
Yeah.
You've got brown eggs, you've got white eggs, you've got organic eggs, right?
Yeah.
You've got, I don't know, 2 dozen, you got dozens. And each of those comes with a price.
Yeah.
So you've got all these different kinds of mortgages. You have mortgages that can only be paid out on sale. So to me, that's one you would want to stay away from.
Yeah.
Because inevitably something happens in someone's life. So the average homeowner makes a change of some sort that has related to their mortgage or has a requirement every 3.2 years. That's the average.
To sell.
Right. And the most popular mortgage to talk about in Canada is a 5-year. Now, there's rates for different terms. So it really depends on the financial plan. How long are you going to be in the home, right? Let's say something catastrophic happens in your life, or somebody loses a job and you've racked up some debt. Is it prudent to refinance some of that debt? So you want to contract that if something like that were to happen, you have options, so that the only option isn't head for the exit door, I have to sell my house. That shouldn't be the option. So,
yeah, I mean, it's interesting because we say that too. Like, we normally use like every 3 to 5 years, people are moving, right? But I guess that makes sense. So like what do you say to those people that are like, okay, Barb, we go with you, and now someone's offering 10 basis points less, we want to go with them. Do you find a lot of people get trapped in that, and then they sign something that they're like, I've seen mortgages, I know how many pages there are. Like, very rarely does someone read them. They're relying on you to explain them, correct?
Correct.
So is that what happens? Like, people are just like, here, I don't care, this is what my payments are, this is what my rates are, but they don't have any foresight for that 3-year mark or 4-year mark or anything like that.
So that's where the advice piece comes in. So I'm big on advice and education to make sure they know exactly what they're getting into based on experience, even mistakes that I would have made when my husband and I bought our first house, right?
Yeah.
Green as green can be. And so you learn from that. And so you want to learn from my mistakes. It's not all about the basis points, because those 5 basis points can end up costing you in the end.
Yeah.
And so for that immediate gratification of a lower rate and a somewhat lower payment, it's minimal. It could be like $5, but for that $5 a month, there's so many other important factors, because the rate is just one number. There's amortization. Are you in a standalone mortgage? Is the mortgage insurable? Is it high ratio? There's so many other factors that comprise that rate, and so many other doors you can get into. So is it a home equity line of credit product where you have a combination mortgage and line of credit?
Yeah.
Those carry different rates. And so you have to look at the overall package.
So if somebody does come to you and they say, hey, I can get a better rate here, the very first thing that you would most likely do is say, okay, well, let me see it. Let me read this. Because you're right. They might be able to get a better rate, but then there's some sort of clause or stipulation in there, and that's the reason why they're doing that. Right. So would you can you would you say, hey, let me see it and let me take a look at it, as opposed to somebody just because that's what people automatically think. They're like, okay, Barb's giving us a rate, and then the shitty thing is that a couple months later the rates could have changed. They don't even know. And then they see it somewhere else, even though you've already probably updated it on their profile. Mm.
So I would, if they're open to it, I would see the commitment and just to find out what it entails, right? Yeah. So compounding is a factor, because again, using that variable rate example, there's some variable rate mortgages that compound semi-annually, some compound monthly, and some compound, I'm going to say daily, although it's really not clear how they compound. It just seems excessive.
Yeah.
So compounding semi-annually, which is how most fixed rate mortgages are compounded, that in itself, you pay less in interest than you do if a mortgage compounds monthly. So compounding is great for saving. Daily interest is amazing, because interest money on money.
Yeah.
It's the same true as on the borrowing, except it's not to the borrower's advantage, right?
Yeah.
So that's something that's important. The amortization is important, right? You can get a better rate for a shorter amortization. However, is cash flow also important? Yeah. So let's say you have a future hope to purchase an investment property or a cottage. You want to make sure that your carrying costs that appear on your credit bureau are low, so you have the best chance of qualifying to essentially carry 2 homes.
So I guess you're saying, I mean, the mortgage can be tailored towards their situation, because at some point, some people might say, okay, I want to pay it off quicker, and other people are like, I just want a lesser payment.
Correct.
So the amortization goes from 25 years to 30 years, and then as a result, it's a lesser payment.
It's a lesser payment, but one shouldn't shy away from the 30-year, because you still, with the right contract, you can still prepay that mortgage, and you can effectively shorten the amortization yourself. So I always say, my advice is take the 30-year.
Yeah.
And then use the prepayment privileges to shorten the amortization. It's going to do the exact same thing.
So, and then when everybody's out here looking, the prepayment privilege is a certain amount that you can prepay down on your mortgage or mortgage principal on a yearly basis, right?
Right. And not all contracts are created equal. Some are once a year on the anniversary. Some offer prepayments that you can do anytime for any amount, as many times. So if it's, let's say it's $100,000 mortgage, and the average prepayment is 15%. There are 20, but let's use the average, 15%. So in that scenario, you're going to be able to prepay $15,000 a year.
Yeah.
Without penalty. Now, do you want to, if you were to do it, had a contract that you could do increments of $100 every 2 weeks, that in effect over time is going to be to the borrower's benefit, rather than waiting, saving the $15,000 and plunking it all down at once.
Because how often do people, I always looked at that with the prepayment kind of big deal. Okay, that's the way I looked at it, because not many people had, every year you have $20,000 extra to just throw down on your mortgage, right? But most guys would rather buy a boat.
Correct. But if you had $20 every 2 weeks,
Yeah.
right? One may not think that that's powerful, but if you did that consistently over so many years,
Yeah.
that's pretty significant. It'll make a difference. It may not be the same as, win the lottery scenario,
Yeah.
but it still will make a difference.
But I like that. Like, and I like being able to show that. Like, even like we talked about it, like just one payment, right? Making one extra payment a year, how that would do for your amortization schedule,
Correct. So biweekly, for example, if you have a 30-year amortization and you pay biweekly,
Yeah.
So essentially biweekly, there's two types. But the accelerated biweekly, basically you take the monthly payment, divide it in half, and it's 26 times a year. Then in effect, you're paying 2 extra biweekly payments a year. Yeah. And with that, it shortens the amortization to, I think, 26 and 3 months. So just by doing that alone.
Yeah.
Without even...
You go from 30 to 26?
Just over 26.
Holy crap.
And then if you were to do, I don't know, an extra, $500 a year, just in little amounts of what you can afford, it's also going to make a difference.
Yeah. See, I think that's probably interesting because I think a lot of people, they'll have extra money, but they won't necessarily have 20,000, but they might have an extra payment in them. And a lot of people, I mean, if they're not that great with money, they'll just spend it on something, right? Whereas they could just put it on their mortgage, and all of a sudden now they're 4 years, just shy of 4 years less from a 30-year term, right?
Correct.
So if they did that twice a year, right? Now all of a sudden they're 8 years.
Right, and then look at the equity scenario. So that let's say they're gonna sell their house, right?
Yeah.
And whatever the price is, they're going to have more funds to work with had they done that, because they will have paid down more of the principal. So it also comes back to them on the back end. It'll allow, so from an equity standpoint, not just, maybe if they stay in that house forever and eventually want to be mortgage free, and if they were really focused on it, pay it off in 15 years, great. But most people don't stay in their homes, right, forever. So the equity scenario is also powerful. More funds to work with from a down payment perspective.
So, and that's interesting because I do feel like a lot of people don't like they don't have any faith that they're going to pay off their mortgage, right? Like they set it and they're like, okay, here's what it is. It's going to be 25 years and that's it. But I look at it like I remember when the market was going, like right now, the market is a little unpredictable, and we're really seeing not rates, they're not going up in the same consistency that we used to see it. So like like around here, we would always see 5% a year, 6% a year, and that was pretty consistent. So like every year we could bank, if you had $1 million, you were getting $25,000 in equity every year, right? And then the next year you'd have 50,000. So I would think of, like, years ago, I used to say, well, let's just make the payments as low as we can get them. And then let's just bank on the appreciation, because then we're going to sell this guy and move to another one. So like I always thought, like I never had any foresight into, I guess that's just being young and dumb too, but I never had any foresight of paying it off because I was always banking. And I know a lot of investors do that too. They were always banking on what the appreciation was, and they couldn't care about the difference with the principal.
Right. And timing has a lot to do with it. So in 2022 and 2021, there were a lot of vendors that would sell their homes. So let's say in the city. So when I say city, I don't necessarily mean Toronto, but the greater Toronto area, let's say Mississauga.
Yeah.
And, they were getting top dollar for their homes. And then they were downsizing or moving out to the area where they were potentially mortgage free. That's also very powerful, right? Yeah, it is. And so that happened. There was so many scenarios that I worked on. And you're thinking, why would you work on a financing for someone that is going to be mortgage free? Yeah. Because in most cases, people need to bridge. So unless you're closing on the same day or closing your sale the day before, you need to bridge. Yeah. And it's very difficult to 100% bridge, even if you're downsizing, because your equity is tied up in your home. Yeah. So when you bridge, even if the intent is to be mortgage free, I always suggest, if you can, you qualify for a line of credit for two reasons. One, it deters title fraud. It's good to have just in case of an emergency. It also offsets the bridge and allows the financial institution to then secure a bridge loan, because again, they're not going to 100% finance that bridge. So the line of credit is a temporary financing combined with the bridge.
Yeah.
And then once their house closes, they can take the funds that the lawyer provides them from the proceeds and they pay off that line, and it's sitting at zero.
Yeah.
And they don't have to discharge it. It's there for an emergency.
Well, and I think that's important. The bridges, like, we're seeing more bridging payments now, and I think it's a great idea. And for those people out there that don't understand what bridging is, can you just touch on that?
So bridge is temporarily financing. And basically because the equity is tied up in your home, so you don't have the cash yourself in your bank account to be able to bridge essentially the down payment and the closing costs to the new property.
Yeah.
So the bank temporarily lends you X amount of dollars to be able to close. And then when your original home sells and closes, the lawyer pays off that bridge. So they pay off the old mortgage in the bridge, and then you're in your new home with whatever that is. Yeah.
So in terms of the bridge, though, just so everybody's clear, they need to have it's basically to bridge the gap between what you're selling and what you're buying.
Essentially, right? That's it. You're bridging.
Even if you're buying something without a mortgage, you still need, like, you'll need that funds. And we use bridging, in our industry all the time. So, like, I like a bridge just in terms of comfort, even if it's just like 3 or 4 days where they can move their stuff out of one house and then slowly move it into the next. So they're not moving out of their house and moving into the next house all in one day. You can take a few days and distribute that work. But the bridge can also help if somebody we can't match up those closing dates, right?
100%. It's a great idea.
Okay. So, but then the bridge itself, you need a firm deal.
So a true bridge, you do need a firm sale of home.
Okay.
Like, you can't get one with otherwise. However, there are options where they still call them bridges.
Yeah. Of
the private nature, so a little more work, fees are greater, that you can do that. You can still do that.
Yeah.
Where they're basically blanketing the two homes. So they're putting a registration behind your current home and the new home so that you can close.
Okay.
And so there has to be enough equity in both homes to be able to, because essentially you need 100% to close on that new home. So yes, but I wouldn't call it a bridge. I would.
Yeah, that's private lending.
That's private lending.
Okay.
And they call it that, but I wouldn't call it that.
But, like, it's nice for people out there to know that's an option, because sometimes someone has a house that they just have to have. They haven't sold their house yet. They firm up on it. Now, it's risky in this market, but they firm up on their purchase and then they haven't sold their house yet.
Correct.
Right?
Dangerous.
So, yeah, it's very dangerous. We do see it, but it is dangerous. So with the bridge, you were talking about the line of credit. So just touch on what that means.
So essentially, you're qualifying for a line of credit because it's temporary. So when interviewing with the client, like going through what their needs are, they say, I don't want a mortgage. So just to clarify, although we're calling it a line of credit is still a secured charge on title. It is in effect a mortgage. So if somebody was in that situation, and a lot of borrowers do have lines of credit and they owe zero money on them. Mm-hmm. So in their minds, it's not a mortgage.
Yes.
But it is.
But the larger the line of credit is determined by how much equity they have in their house. So if their house is paid off, they could do 80%.
No, the max is 65.
Okay, 65%. And with that 65%, if they're downsizing, they may be able to take that whole thing and purchase a house just with that, correct?
Correct, if they had the funds.
Okay, and then when this house sells,
correct,
where does that line of credit go?
So it depends on where they put this. So for example, if the line is on the house that they're selling, and it was zero, and they had enough funds to purchase, cash, let's say, right? They don't need a mortgage at all, and they had enough funds on this line. Once house one sold, that line of credit would need to be discharged.
Okay.
But in the scenarios, which is good to have. So one piece of advice is when you're seeking credit and when you're setting things up, maybe not your first time, but as you have equity in your home and you can qualify, you should qualify for a line of credit, like a secured. It's one of the best facilities to have, in my view. It gives you optimal flexibility. So it will allow,
even if you don't need it.
Even if you don't need it. Let's just use an example where you have investments. Right now, the market has dropped. I don't know. It's pretty depressing if you look at my investments right now, but say 6,000 points.
Yep.
So you have these funds, you have this line of credit, and you want to purchase, and you were thinking you were going to redeem some of those funds to help with the purchase. But do you really want to take it out of the market right now? Because once you cash out, you can't get it back, right? Like it's at the value that you're cashing out. So maybe it doesn't make sense to take it out right now. Maybe it makes sense to pay the interest on the line of credit so you at least have a chance of recouping some of the gains that might be coming forward, right? Okay. So even in that scenario, even if you're completely liquid, it may not be the best scenario for your personal financial situation to redeem everything at this point in time, to take it out, right? Because you're essentially cashing in at that point.
But the line of credit too, it's like a rainy day fund, right?
Correct.
You know what the interest rates are, right? So
you need a new roof, right? Or a car, and let's say the car lending rates are 10%, but your line of credit rate is at prime if you're lucky, and it's 4.95. Makes perfect sense to do it that way.
Okay, so fair enough. So you mentioned something there, credit. So this is run, and I always thought it's a funny term, but credit seeker. Okay, remember you'd mentioned that to me one time before, where you'd have like, so if somebody's out there and they are trying to figure out who they want to go with in terms of a mortgage broker, and then they go to multiple different brokerages or mortgage specialists, and they're getting qualified all of those different institutions, does that affect their credit?
So qualifying, typically they don't run credit. So the difference between qualifying and being pre-approved is qualifying, we're running numbers. And there's different types of qualifying. So for example, Tyler could be sitting in my office and he could be saying, I make this much, let's say, right? And then I'm inputting this data into a system and it's going to spit out, I'm going to put this much down, but I haven't verified everything. I wouldn't know if you actually made that or not. I could be taking your word for it, and I could say, well, yes, you qualify for, a $500,000 mortgage. Make sure the taxes are about X, and you have no debt, or you can still carry this and that. I haven't verified a thing. That is meaningless.
Okay.
Right? It means nothing. Yeah. Then you have qualifying. We're looking at paper. So I'm looking at pay stubs. I'm inquiring, are you self-employed? Because that looks different. That's a different qualification, like a different examination of documents than someone that's just straight salary. Or maybe your commission and salary. Yeah. That again, the numbers are different. So we're examining the paper. We haven't necessarily checked credit yet, but we have a good idea of how things are gonna shake out. Yeah. And
that's a pre-qualification.
That's a qualification. I would call that a thorough qualification. Okay. And then there's the pre-approval. The pre-approval, we typically pull credit. Okay. Right? And most times I'm using Equifax. Now, one thing to be cognizant of is when you are pre-approving, I would say in some cases, unless the paper is worked, meaning someone's actually examined everything, it's decent. It's going to hold a rate, right? It's going to illustrate the lender's okay with the credit, like it's cool, but it's also not necessarily means, hey, I should go firm on this purchase
for the pre-approval.
With the pre-approval,
but they do credit check with the pre-approval.
You have to, if you're going to submit for a pre-approval, credit has to be checked.
So what's the difference about the pre-approval that they're not doing? Like, why wouldn't you be able to say, hey, I'm going to go in firm because Barbara's pre-approved me?
Because they haven't necessarily. So I can pre-approve and I can send it in. We'll get a certificate back from XYZ lender. Yeah. Right. but they haven't necessarily fulfilled the conditions, meaning they've got general conditions, but every commitment has conditions, and you can have 20 conditions and you are still approved.
Yeah.
But until those conditions are fulfilled, that financing is not firm, right? Mm-hmm. And also on a pre-approval, there's no property. We don't really know what the taxes are. We don't really know the location. It could be a condo where there could be some derogatory, or the reserve funds are low, and then the lender won't lend on it because of that reason, right? Okay. Or a country property, the water quality, or there's something wrong with, the septic, environmental things, or it doesn't have UV. I'm not sure, whatever the requirement is. So it may be looking at you, the borrower, but it's not looking at the whole picture.
But there's no, like, other than the pre-qualification before you're so there's no other way for them to guarantee that, like, they should put a firm offer in on something, is there?
So there's no ever guarantee to put a firm offer. So in the sense, you're probably not finding it now, but a couple years ago when it was very competitive, all we can do as lending professionals is provide as much comfort level as we can. Yeah. And then it is the borrower and the buyer's decision whether they want to go firm. Yeah. Before that financing is approved. And they have to be comfortable with things that may happen. Now, 9 times out of 10, if we've done a thorough job, it's going to be fine.
Okay.
Right?
So then when you're doing that, okay, so like, let's just say they go around to a couple different mortgage brokers, mortgage specialists, and then they go ahead, they get a pre-approval with the credit check. Does that affect them?
So a credit checks, for the purposes of a mortgage, as long as it's done in a 4-week period, it's not really going to affect their credit. Are inquiries going to affect their points here and there a little bit? Yes, maybe 2 or 3 within
not
10.
As much as it used to.
But what's it like? It's really not going to impact someone. I'm 800 today and I'm 790 tomorrow. Okay. You're still getting that mortgage, right? If it's a big point spread, and when I say credit seeking, you're going to Walmart for a credit card. You're going to Petro-Canada for a credit card.
And then they can see that on your bureau.
You can see all these inquiries, right? And that is someone, like, they've gone to 5 different trades, a car loan. Like, there's normal things you do.
If you go to a car loan 3 different times and you don't get approved, that would be on your bureau?
Well, you could, if each time you wouldn't, there would be a reason why you're not getting approved.
Yeah.
Car loans are really easy to get approved for. I shouldn't say that out loud, but they are. So there's a bigger reason.
And that's another thing too. It's like, if you get approved for a mortgage, please do not
make any changes.
Yes. So that means don't go buy a car.
Do not go buy a car.
Okay.
You close on the June 30th. You go buy one on July 3rd, the day after the holiday.
So one of the things that and we're going to get into rates a little bit, because we've been talking about variable rates and pre-qualifying, but appraisals. So, we ran into, like, as the market was going up, okay, and this surprised me, okay, but like as the market, like, we were 25% a year, the COVID market was jumping up, and the properties always seem to appraise, okay. Oh, there. And the properties always seem to appraise.
But I'm doing good, right?
Right. But as we go down, okay, that's when we really realized, okay, the appraisal we really have to work on this appraisal. So we had issues where we bought a property, and then 3 months later when they moved in, let's say it was 1.2, and then when they moved in, the market was down to 1.15. Okay, so it was a $50,000 from when they bought it. Then the appraisal comes in, which is only a few weeks before closing, and now our buyers would have to come up with the $50,000 difference in the price.
Yeah, but that shouldn't happen. There can be a value gap if someone purchases. Let's use months because you're talking. So let's say someone buys May 1st, right, and then whoever the lender is that they're dealing with doesn't order the appraisal until a week before closing. So let's say they're closing July 30th.
But that's normal, right?
No.
Because that was always a thing for me, and I think, like, when they do if you're qualified, why wouldn't they order the appraisal like and have it a week later, 2 weeks later? But normally it's always closer to closing, isn't it?
So it depends on the professional you're working with.
Okay.
So I order appraisals right away.
Okay.
Just because you should appraise in the market that you're buying.
Yes.
Just like your advice would be sell and buy in the same market, right?
Because we were having to talk to our buyers and say you should call your lender and get a rush appraisal, because then that way that could guarantee that the appraisal happened within the value that you're purchasing in.
Right. So that's when the mortgage shopping can be a problem, right? Because if that property is in that appraisal spectrum, meaning it has to have a physical appraisal, if you're going to multiple lenders, then each one of them, depending on the criteria, may want an appraisal. And it depends on their policy when they lend them. Maybe that's not in your control. But in the GTA, and because I'm sure in the GVA and metropolitan, like Greater Vancouver area, but let's talk about our market. There is also automated property valuations. So some lenders have excellent automated property valuation tools where at the time of approval, they may charge $100, they may charge $300, but it's done right there and then, and no physical appraisal is required.
But it's online.
And so you're good. That's excellent. That's the best approval you can get. You don't have to worry. And then there's others where maybe they do a drive-by or they do need a physical appraisal. But if you have the control to order the appraisal up front, so it's done in that upfront period, that's the best time.
If you have the control, do you not normally have the control?
It depends on the lender, how they're structured. Like for in my world, I have to order the appraisal.
Okay.
Right? And I usually on the A side, because B side is completely different. Whole different spectrum.
Yeah, the B side will have their own appraiser, right?
Right, or they have a specific list, or I can go direct, right? But each lender. So normally we order through an appraisal company like Solidify or NAS. And then sometimes for certain lenders, I don't know who it is. I'm not allowed to know who it is, right? And we order it. So when I order it, I provide the information for the client, the listing agent. The client pays for that appraisal, and then it goes through.
Yeah.
And the arrangements are made with that listing agent through the vendor or with...
How long does it take to order an appraisal? And does the client always pay, or do lenders ever pay?
So on the lender side, the client always pays.
Okay.
Or in each and every case. I typically, depending on the file, may reimburse it later. It just depends on the nature of what's going on, right?
Okay.
But in the end, it gets deducted from the advance of the mortgage, or it's paid up front.
Okay.
So in the end, the client always pays through the appraisal. And I'm going to digress for a little bit, and then we'll go into the value. And clients always wonder, why can't I have a copy? Is because there's other private information, and yes, you're paying for it. Just like a lawyer, you are paying for the lawyer to facilitate the closing, but the lawyer is really acting to protect the lender's interest when registering a mortgage. So it's the same thing with an appraisal.
So it was always, and that was always interesting to me too, because you never really found out if it would just appraise.
Correct.
Okay, it wouldn't be like, well, what did it come in at? We were like, oh no, the property appraised for the value or the value range that you've purchased it in, everything's okay. The only time you'll hear, obviously, a negative if it doesn't appraise, and then if it doesn't appraise, will they tell you the value?
I always tell people values. Value is not a problem because we get that, but we don't necessarily get all the details of what the comparable was.
Yeah.
We may not get all that. And the appraisal report is prepared for the lender, and it stays in the file with the lender. Right, it gets transmitted to them.
So here's something that everybody always says: the bank appraisals are always lower than the market value. True or false?
I'd say true and false.
You can't do that, Bob.
I can, because on a purchase, it's different than on a refinance.
Okay, so on a purchase, tell me on a purchase.
So.
True or false?
I would say that it's false.
False.
Because a professional realtor would have done their job and look at comparables and say, this is pretty fair. Because an appraiser, that's what they're going to do. Mm-hmm. They're going to pull comparables within 90 days.
Okay. On a refinance, it's true.
on a refinance, it can be true.
Okay.
Yeah, because
you're right.
you're dealing with a number that someone said, well, the person down the street has their house listed for 1.6.
Yeah.
But maybe it's not going to sell for 1.6. Maybe it's going to sell for less, or that other home may have, I don't know, a gold bathtub. I don't know what that's worth, but some different upgrades, I guess is.
So for me, when I have, you're right. If I have a seller that wants to refinance, or a property owner that wants to refinance, they would, like, when they pay for the appraisal, okay, and they'll know. Like, I had one the other day, and he's like, "Well, geez," he's phoning me. He's like, "Here's what it was. I thought we'd be at least $950, but they came in at $875. Right? It was like, it was low even for us." So he said that they gave him an opportunity to, show otherwise, and that's when he came here and we went through some sales, and we had some sales that were pretty damn close to that 950 range. But that was with him refinance, so it wasn't with him purchasing a new home.
Right. So on your refinance, unless there's something really significant that you need absolute dollars, not as is not as important. On a purchase, that's important, because if so here's a perfect example, and it's a bit sad, but it has happened. So let's say you're buying a new construction. And let's say you purchase that new construction. Let's pick on Fergus. Fergus is a very nice town, but they have new construction. I'm not going to pick on a builder.
Let's do it.
But let's say the base price was $1,050,000 for a detached home in a subdivision.
Yeah.
And then the client went and, I'm going to put in this kind of kitchen. I'm going to make sure there's hardwoods. They're paying for all those upgrades.
Yeah.
It's then going to get added to that purchase price.
Yeah.
Right. So on the resale side, you're looking for certain things, but you might not get every dollar back out of every improvement you made. Correct?
Yeah.
But on that purchase, it's really important because you've added all that, and that price does get, those improvements or upgrades get added to the purchase price.
Yeah.
Let's say that closing date was set for a year and a half later.
Yeah.
And then, lumber shortage, trade shortage, that closing date is now pushed to 2025. So let's say it took 3 years to close. It might 3 years or aggressive on the time, but it does happen. It can take that long. And so you purchased at the height of the market in 2022. It's now 3 years later, you're closing, and now it's only worth $950, but you purchased for 1.2.
Yeah.
And it's going to appraise at $950. However, you owe the builder 1.2. You've already given them $100,000. If you don't have the reserve to make up the rest, then that's a problem, because the bank is only going to lend on that $950. They're not going to lend on the 1.2.
Yeah. So, I mean, and that's been a big issue lately. I know it's a big issue with condos. I want to talk about like a blanket appraisal, if you're familiar. I don't know if you're familiar with that or not, but it's just something
where the builder guarantees
does a blanket appraisal for the whole building, despite the market being down 20%. So we'll talk about that in a sec. But so okay. So, and I mean, so that's the issue with the. So had they have gotten an appraisal, they couldn't get an appraisal until the builder was like 90% complete or something, right? Like you couldn't get an appraisal at the time because the property wasn't built.
No, you can. It's just, it depends on how that purchaser dealt with their approval. So there are programs out there that will allow for an approval up front. And you can order an appraisal in certain cases in the builder space. It depends on the lender and what's going on. But then if the build takes a long time, the lender, even though that approval is going to expire, right? Approvals aren't indefinite.
So it is like, and that did happen in Fergus, right? I know a few spots. But even if like the builders, I mean, for the builders that ask for 20% down is smart because it's tough to walk away from. But, some of these condos in Toronto where, it's, they bought it in 2020, let's say the beginning of 2022 with 5% down, and then it's dropped 25%. a lot of these people that were going to buy them aren't buying them anymore because they don't have that much into them. And it's when they bought it, it's 25% less than market value right away. So for them, it might be easier for them to walk away from the 5% than buying an asset that has negative equity. Yeah. And having a mortgage on it with negative equity.
Right, but you have to be careful because the builder at that point has the right to sue.
Sure.
And they do.
Do they?
Yes, they do.
Yeah?
Yes. I don't know of all the cases, but they have the right to sue.
Yeah.
And if you've signed a legally binding document that you're going to purchase,
yeah,
and they may sue for damages, meaning, they would sell her at a lesser price, and whatever costs there were to relist it and litigate it. So I doubt you would get off 100% scot-free.
So, and that's where I guess we were talking about the blanket appraisers, where we're seeing some condo builders are able to give a blanket appraisal for when they purchase the property. So all the sales that they're using as comparables are within that building.
With a certain lender.
Yes, with a certain lender.
Right.
So that lender guarantees the mortgage at the value of when they purchased it.
Correct. But then that person still has to qualify for that mortgage.
Yes, and if they don't qualify, then they can't.
They can't proceed with that.
And that's happening too.
Right.
Okay. Okay. So let's go back a bit. So in terms of we've talked about our variable rate mortgage. Okay. Let's just go through we've talked about our rates. Okay. So let's just go through the difference between a variable rate mortgage, just in terms of the actual rate, versus a fixed rate mortgage.
Okay.
For residential in today's market right now.
Okay. So we've talked about variable and the discount.
Yes. So you said that prime. So the overnight rate is 2.75. Prime is 4.95.
Correct.
And then the discount, you said was 60.
I would say on average right now is 60.
Okay. So
you might get 70. You might get 50.
60 basis points. Mm-hmm. So then that puts you at like 4.35.
Correct.
Right? Okay. So at 4.35 is a variable rate.
Correct.
Okay.
On average.
Okay. Now, have you seen lower than 4.35 on a variable right now?
You might within 10.
Okay.
Right.
And would it matter if I had a variable rate that was like a 3-year term or anything?
So most variables are 5 years. There's some lenders that will offer a 3-year variable.
Okay.
But the key part of a variable is that it when you go towards the penalty, if you try to break it, it is inevitably 3 months interest.
Okay.
And that's the biggest differentiator between fixed and variable.
So at a variable rate, 4.35, depending on the lender. So it could be less, could be a little more.
Mm-hmm.
Okay.
And it would depend, like insurable. So this is getting into another. So if a property is insurable, or high rate. So there's insured and insurable. So insured means high ratio, less than 20% down. And the government just recently in December expanded that to include a 30-year amortization, where it used to be 25.
Okay.
And expanded that for first-time home buyers.
Okay. Just for first-time buyers.
First-time buyers or buyers of newly constructed properties.
Okay.
However, when they're talking first-time home buyers, only one of the purchasers have to be first-time.
Okay.
And they can still take advantage. And let's say you haven't owned in 5 years. I think that's the timing. You are also considered first time.
Okay.
Or let's say you were in your matrimonial home and the parties went separate ways.
Yeah.
And they're not, one of them is not keeping, they're both going their separate ways, selling the home and each purchasing a new home. They are also considered first time buyers.
So that's interesting. Okay. So then, so we're at 4.35. So if I want to put down, so we have insured mortgage or uninsured, right?
So you have high ratio, less than 20% down, and then you have insurable.
So what am I going to get a better rate? Less than 20% down or with 20% down?
So less than 20% down, you're going to get a better rate.
Why?
Because the mortgage is secured by an insurance.
Okay.
So Canada Guarantee, Sagen, or CMHC. Everybody knows CMHC. They probably don't know the other two.
Genworth.
Genworth is now Sagen.
It's Sagen. Okay.
Yeah.
So then we have, at 4.35, would I get a better rate if I had an insured mortgage?
Yes.
What would that be?
You'd probably get minus 70. Even up until a couple of weeks ago, it was minus 90. It's only recently changed.
So a couple weeks ago, I could have got 4.05.
Correct.
Now I might be 4.15.
Yeah, you might minus 70 is pretty doable.
Okay.
In the insurance space.
4.25.
Yeah.
Okay, 4.25. But a couple weeks ago, I could have got 4.05.
Right. And if it's high ratio and you qualify as a first-time buyer, you still are able to get the 30-year amortization. But then there's an insurable mortgage. So that is the cap is the purchase price is capped at $1 million.
Okay.
So different than high ratio.
Okay.
Typically it's 65% loan to value. So you're putting 35% down. Then you can have an insurable mortgage. So it's still packaged up. So think of it as a mortgage that you're packaged up and the bank is no longer taking the risk, right?
Because I've got 65% down.
35.
But then am I still paying the mortgage insurance?
No. So the lender pays that. You don't see it. So they're packaging
because you have more down?
Because it meets their criteria where they can securitize that mortgage.
Okay. So then what happens with the rates there?
So they are similar.
And it has to be under $1 million?
It has to be under $1 million.
Come on.
Yeah, that's the way it is.
Okay.
And a big down payment.
And a big down payment, like 35%.
Right.
Okay. So at 35% down payment, what would my rates be there if it's insurable?
Similar to high ratio mortgages.
So
minus 70.
So okay, so very similar. So it wouldn't why would I benefit having an insurable mortgage?
So insurable mortgages come more into play when we're refinancing, and sometimes it makes sense to do insurable switch where the value there's some some options there to be able to take that and securitize that to take advantage of these differences.
Okay.
Right.
So then let's jump to fixed. Okay. Or I guess last thing. So I was online the other day and I saw, a couple of weeks ago, 3.99%. So you have people I don't know if it's clickbait online or anything like that. Have you ever seen anything like that? Or is there any, why would we be able to do 4.05 here or 4.25 here and then someone do 3.99?
So 3.99 is most likely fixed because I haven't seen, you don't typically get discounts of prime minus 71. Not to say they're not available, they are, but usually in round numbers.
So it's fixed.
So it's most likely fixed.
Okay.
And on high ratio, they are out there.
Okay.
So less than 20% down.
Okay, so we're going to get into that with the fixed. Because historically, right, it was always the variable rate was always lower than the fixed rate, right? For a lot of duration of my career, that's where we could I always used to choose a variable rate because it was always lower.
Well, because prime, it just depends on what prime is. So the COVID phenomena has certainly put things upside down. But even in COVID years, like 2022, end of 2021, you could get a fixed rate mortgage for 1.65.
Wow.
For 5 years. You can't get that today.
But before COVID.
Before COVID, I would say in the twos, 2.5, 2.2. A common, I don't know if you remember, but it was always a big thing, the 2.99, right?
Yeah.
It was just under 3%.
Just under 3, yeah.
So that's a fixed rate. Yeah. And there's borrowers that want that payment secured, and fixed rate makes sense for them.
So let's jump to fixed rates. Okay. So I want to get a fixed rate mortgage. I want to put down 5%. So
you could absolutely today get 3.99.
Okay. Can I get lower?
There's some specials out there that you could get to 3.79.
Fixed 3.79. Fixed 3 year. Fixed.
So 5 the 3 and the 5 year are pretty close.
Okay.
Right now, I am of the opinion that the 5 year is a long time.
Okay.
And because there's so much volatility, I'm not sure that I would get into a 5 year mortgage. I think it makes sense. It's payment security for a long time.
Yeah.
But I think, in my view, 3 years. It gives you some options.
Yeah.
It's going to bring us, 3 years from now, it's going to bring us to another election pretty close, right? Not necessarily ours, but, there's a lot going on. And the spread right now isn't that big between a 3 and a 5 year. Okay. So usually a 5 year would be more cost effective than the 3 year because it's a longer term. You're going to be in that term longer. Mm-hmm. Right now, that that spread, it's not that significant. So I'm not sure the 5-year
is the way to go.
Is the way to go.
So if you had so the a 3-year. So you said 3.79.
That's as low as I've seen it.
Okay.
No, I didn't. I don't know if that's a 3-year. That might be a 5-year.
And are those mortgages that we talked about earlier, where the conditions are geared towards the lender and not the actual mortgagee?
So sometimes you'll have rate specials out there, and it'll have a due on sale clause. So the only way out is when you sell your house.
Yeah.
Right. So you have to be careful of
But
that contract.
You would let your client know that. So if I was like 3.79 versus 3.99, but that you had the sale clause,
I wouldn't do the one with the sale. I would not do the restricted mortgage, no matter the rate, because life happens. And I know one would like to think that it's, some people may be in their homes for 10 and 15 years, and looking back, maybe that was a great idea.
You may think you're in love, but you're not. Is that what you mean?
No, but we've been in our house for 20 years. So would that have been a good idea? But we're not the norm.
Yes.
Right?
Yeah.
Right. So people do move, or let's say you get transferred. There's a lot of things that can happen. Mm-hmm. So to me, a due on sale clause option, to me, is not worth it.
I even think even people that are, in a relationship, they're not married and they're wondering whether they should buy a house together and all this stuff. And I always think it's a good idea because of they're paying down their mortgage, the house is increasing in value. And, if they do get a mortgage where they can sell without, if it's a variable and it's a 3-month interest or whatever it is, there's, even if the relationship doesn't work out, they still get their hands in home ownership. They're still building some equity. So I always think it's a good thing no matter what.
Right. But it's just to have it to be restricted, to have a restrictive contract, I don't think it's worth it.
No,
right?
I agree.
You also have prepayment privilege restrictions, right? You not necessarily prepay to the same extent. Even if you never use your prepayment, I think it's still important that you have that privilege, mm-hmm. because it can come in handy at some point.
So so then if I'm looking at a fixed rate mortgage at 3.99 for, let's say
3 years.
3 years, okay. If the overnight rate goes down 0.25% to 2.5, from 2.75 to 2.5,
mm-hmm.
does that mean that my fixed rate mortgage at 3.99 goes down in the same capacity?
No. Because fixed rates are set by the bond market.
Okay.
So the bond market, so it's been not a lot of people, they think the government sets the rates. So they
kind of do.
They don't.
No?
The government doesn't set the rates. I know that people think that
fixed.
They don't.
Okay.
The bond market sets the rates.
Okay.
There may be, certain premiums, and banks may want to hold certain spreads and profitability to keep rates at a certain level, but the bond market would drive the rate. So the bond market is worldwide, and it's basically investors buying treasuries. Now, they could be U.S. treasuries, they could be Canadian treasuries, whatever the treasury market is. Now, the bond market works opposite to supply and demand, and essentially treasuries are debt. So let's use the U.S. example. So in the last couple of weeks, when they had I don't want to get political, but the whole tariff liberation day, blah, 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 whatever. Yeah. What essentially, when he announced that, there was a fall in the stock market and a fall in treasuries, meaning the yield increase. So what that meant was that bond investors were selling treasuries. So you would think of the price of gas.
Yeah.
So the more gas is available, like the more supply, the cheaper it is.
Yeah.
That's not, bonds work opposite. So you would think that it would be cheaper when they're selling them, but that's not the case. So the more investors invest in bonds, the better the yields are, the cheaper money is. When there's bond outflows, the more expensive money becomes. So if we were not in this trifecta of tariffs and election and all this, I think bonds yields would be better right now, but they're actually really sticky. They have virtually not changed in the last 3 months or 4 months. They've come down from the highs. So for example, in 2023, your average 3-year rate was in the high fives, or even like 6.05, I think was pretty average. So they're down from that because we're at, if we're high ratio at 3.99. So they've come down an awful lot in that time frame. But just in terms of, just think about how much the overnight rate has come down, or prime has come down, not to the same extent in the last little while.
So, because it was always a funny time when the rates started to go, in 2024, right? The rates started to come down, right? End of 2023, beginning of 2024.
I think the first cut was July of last year, July or June, I think. Yeah.
2024. So, okay. So like for us, whenever we had a rate cut, our sellers would turn around and say, okay, give me the money. Like, where's all these buyers coming in? And we would always explain that, like when I mentioned before about fixed and variable rates, okay, like forget about COVID, the variable rate was usually cheaper, but it came with a risk, and the fixed rate was usually higher, but then you locked in and you had the comfort of locking in. But then when the rates started to change, the fixed rates dropped faster than the variable rate.
Correct.
Okay. So then what was happening was that when the overnight rate, was coming down, the fixed rate, people were taking the fixed rate product at your recommended 3-year, which is probably still what you would recommend, right? A 3-year fixed, right? But that's what was happening. So the fixed rate was already down, and then we're chipping away at the variable rate, but it didn't really have as much of an impact because people were taking the fixed rate product and they weren't taking a high variable rate.
Correct. So the reason for variable in that environment, which last year there were a lot of, anecdotally speaking, I did quite a few variables in 2024.
Really?
And the reason for that is there was a lot of noise and projections that prime was going to start to come down, and fixed rates would come down more. So even last year at this time, an average fixed rate would have been 5.09, and that was considered a great rate.
Yeah.
So, 5.09, 3.99, a fair bit lower,
it's
right?
huge.
It's still important. It's significant.
Yeah.
And so another reason for variable, if you can handle the letters that come when prime decreases and the letters that come when prime increases, because you're going to get a notification. If you can sleep at night, like if you're not going to worry about it, then, and you have a good discount, variable is a great option, because every institution has lock-in provisions.
Okay.
They may be different when you can lock in, but you can lock into a fixed rate without penalty.
Okay.
It may, like, typically you, like, an average lock-in would be if you're in this variable for 2 years, then you can lock into a 3, 4, or 5-year rate, right? Yeah. Maybe not a 3, because you'd have to just hit past the 3-year anniversary rate. So that usually the term has to be greater than what you're locking in. Like you have got to be into your variable to lock into, you have to be to lock into a 5-year, you could do it 3 months later, let's say, or a month later. Okay. To lock into a 4-year, you'd have to get past your 1st-year anniversary. To lock into a 3-year, you've got to let 2 years go by. But you have the ability to lock in on the rates on the way down. So for those that, like even last year at the beginning, either that have those variables, I'm not sure they want to give them up because they had excellent discounts. Like if you got Primus 90, I'm thinking you might not give up that.
So that discount stays with you for your full 5-year term.
Correct. That's why the discount is so important.
Oh,
yeah.
Shit,
It just doesn't change.
Why didn't you just say that at the beginning? We wouldn't have to talk for an hour.
Yeah.
Where are we at for time?
Hour and 20.
Okay, good. Perfect. Yeah. It's great, eh?
Yeah.
We're gonna keep going.
Okay.
So that I just want to touch on that discount. So if let's just say right now there's a discount, prime minus 90 for 5 years.
So you're at 4.05.
Yes. Now, as the overnight rate comes down, okay, that means that my rate's going to go down.
It should, if the bank follows through on their reduction.
Okay, but does that happen? If the overnight rate goes down, aren't the banks obligated to go down with it?
Morally speaking, yes. However, they have not always done so. So there are 3 times in the last, since 2007, that they have not extended the discount. So it is up to them to extend. But there would be a lot of pressure on them to, given that they've gone up with every single rate hike, that they should come down. But there are 3 times that they did not pass on the discount.
In history or in recent, like...
I don't know of all, but 3 years in my lifetime of being the mortgage. So in the last 17 years, they have not...
That's a long time.
Yeah, right. So they have not passed down the discount 3 times.
Okay, so then... But, like, it would make sense, right? Like, so if what are we at here? 2.75 and 4.95. So the bank is, like... The bank is making 2.2% on prime by offering us.
Yeah, it depends. There's a lot of things that go into pricing.
But then they have their discount.
They have their discount. So it depends on what their own internal spread. So it depends on what they have on deposit. So the best way to look at it is a bank wants your deposits, right? In the end of the money, using someone like me is great. You want someone with great advice and that's going to look after you, right? You want to do the right thing.
Yeah.
However, at the end of the day, the money does come from a bank.
Yes. So, but then, okay. So, like, what's the biggest discount that you've seen? Or
like the biggest would have been prime minus 1.10. What I'm trying to say is, though, it depends on the institution. So, a bank, you bring in your money, your deposits. Let's say you buy a GIC. Today, you can get a 1-year GIC for maybe 3.55, right? That's for 1 year. But they're lending that 1 year money out at, I don't know, let's say 5.8. I'm guessing a little bit. So when they bring it in, they're paying you on those funds, but not as much as what they're lending. But they're basically lending your money out on mortgages. So that's where the bank, other than fees, and we're not going to get into that because then people are going to get their blood pressure up. But that's where essentially their spreads come from. So the more funds a bank has on deposit, the more they can lend out.
So yes, and there's a certain percentage on that.
So if prime were to go down and they honor, they're going to reduce prime, their bank prime, then bank prime becomes, so it's at 4.95 now, so minus 25. So then that rate, if someone has that discount, they're paying 4.05, that 25, they're going to be paying 3.8 at that point.
So, but that like, let's say that 0.9, 90 basis points, the discount that you're getting as the rates go down, and if the bank follows suit, which normally they do, then it would be safe to assume that, like, as the rates go down, I would assume that the discount probably goes down too.
Not the discount.
So my discount's locked in.
The 90 stays with you.
So that, but for a new mortgage, let's just say that instead of 4.35, now all of a sudden the banks are lending it at 4%. Okay, that discount on that mortgage would most likely go down. It wouldn't stay at 90. So
if you have 90, you're good.
Okay,
it will not change. So your rate is going to, if the Bank of Canada next meeting, which is in June, if they drop by 25 basis points and you have prime minus 90, you're going to be paying 3.8.
Yes.
Right?
But what I was getting at was that then that if they drop the basis points 25%, or 0.25, sorry, then a new mortgage, most likely the discount on a new mortgage after that drop would be a less of a discount.
It depends. It depends on their profitability spread. So right now the credit spreads are tight, and so they don't have it in their margins to offer more of a discount. But if you go back, money was pretty cheap in COVID, right?
Yeah.
And you were getting discounts of prime minus 1 and prime minus 1.15, but the spreads, their profitability was so that they could allow for those types of discounts. Okay. So it just depends. In this environment, because of what's going on, the margins are thinner. That's why you're not seeing the same discounts that you were.
But if you have a big discount, it's important, like especially as the rates are going down, then that's a huge plus for anybody out there.
Right. Just when people borrowers think of borrowing, like locking in, they think they're locking in at the rate that it's come down to. That's not how it works. So for example, we take that COVID example and they're in at 1.45. They can't lock in at 1.45. It depends on what's going on with the fixed rates at the time. So if we use that COVID example, they didn't start increasing rates until March of 2022, I think. I'm pretty sure that's the case.
Yeah, it's like the second week
right?
of March.
Fixed rates had already jumped by then.
Yeah.
Oh, well over 2%. I think in March of 2022, I think you could still get, they were hiking 2.79, 3.18. Like it was constant rate increase. Like it was nonstop. Like I had gray hair because you're always trying to lock in rates, right?
Yes.
And so not a really, just like multiple offers, losing out, it's the same thing. You're just, on a Friday night, rates are going out. So you're trying to lock in as many people as possible, to do what's best for the client. And so it was pretty stressful to work in that environment, but you couldn't lock in to that 1.45. So you're locking in at the time of whatever the fixed rates are of the time. So in a inclining rate environment, locking in, if you miss the boat, you should ride. Like my theory was ride the wave, even though the wave went pretty high to 6%.
Yeah, that's
right?
hard.
That was a big wave. But riding wave now is not as difficult because it's on the way down.
Because if you locked in at 6%, then you're stuck there.
You're stuck there.
Okay, that makes sense. So I mean, overnight rate, prime rate, and discount. So just if anybody takes anything from this, take that, okay, to help understand this. I do feel it's interesting about the discount and how important that really is. And that's one of the reasons why you have your terms with your variable rates, right? Your 3-year term or a 5-year term. Okay.
Right.
So now with we've got our an idea. Everybody out there has an idea right now on what the fixed and the variable rates would be. Okay.
And they're pretty similar right now.
They're subject to change. Okay.
Yeah, fine print.
Everybody's always telling us that. So then let's just talk for a second. Like we will talk about the tariffs. So in our industry right now, we are noticing everybody's hesitant. The tariffs are affecting, for the majority of them, they've been put on pause, and the tariffs are affecting certain people in the auto industry and steel and aluminum. But right now, we're seeing buyers are still cautious because everybody's not sure what's going on. We've got tariffs, we've got an election coming up, but the rates right now, in your opinion, you would think are relatively safe.
Yeah, they're
you don't think they're going up?
I don't think they're going up. No, I don't. Well, they have been. Yesterday, a lot of lenders did announce some increases to fixed rates.
Yeah.
By 10 and 15 basis points. So they are moving, right? So that 399, because it's always subject to change, may be a little harder to get.
Yeah.
Today than it was yesterday. But I think that once there's some sense of stability in the markets and bond investors are more comfortable in investing in bonds again, because normally when you would have economic upheaval, something like what's happened, bonds are a flight to safety. So instead of investing in the stock market, you invest in bonds, rates come down. It didn't happen like that this time. Right? So people were selling treasuries and selling their stocks. So they're buying gold. We can't, I don't really understand the gold market, but gold is pretty hard to, liquidate, but it's probably the safest haven.
Yes.
To look at it that way. So that's what's going on. So fixed rates have been sticky. So even a couple weeks ago, for example, I look at bonds every day and try to get an idea where the market is going, what kind of trends. And it has been slightly reversing. So even 2 weeks ago, I forget one announcement was made in the South that made it more attractive. Something positive was said. And so things react on whatever comment. There's been so many comments, I couldn't tell you what triggered it. But a 5-year bond is the one I watched the most, was trading at 2.42.
Okay.
Great. And then the bank purchases, they have to buy it at a premium, they got to put their spread on, so that's how they get their fixed rate, right? There's swap spreads and all this, layers and layers, just if you were buying, again, eggs, so there's transportation, whatever costs go into that. So that has now reversed itself in the last 2 weeks because of the sell-off in treasuries because of more uncertainty. And so that's had an effect. So now that same bond today is trading at 2.80. And yesterday it closed, I think, at somewhere around 2.85. So that same bond got essentially 40 basis points more expensive. Now, lenders they don't adjust their rates on every bond move. There's a range, right? So something triggered them in the last couple of days to increase their rate by 10 to 15 basis points. So the profitability would have changed because of that.
Okay, so like, okay, that makes sense. But like, if we just in terms of the market overall, if like we just had a rate hold, okay?
Yeah, held steady.
Okay. Now, does that not give you any indication that says, okay, you know what, maybe we're like, if everybody was really worried about the tariffs, right, which they are, but I mean, if the government was,
which they are,
but would they not lower the rates because they want to stimulate the economy, right? So if the tariffs were having that big of an effect, why wouldn't they lower the interest rates to try to stimulate more spending?
So I'm not an economist, but I watch it pretty closely. But I listen to some of the smartest people, I think, try to get all perspectives.
Like me.
So it's important. So and research it. But the bottom line is they need some wiggle room, and they're not really sure which way this is going to go.
Yeah.
So at this point in time, I don't think it was prudent of them to cut. I thought they would hold.
Yeah.
Sometimes I think we should take wagers because there are lots of times we're wrong, but I thought they would hold because things are pretty stable at this point. Have there been job losses? Yes, there was an announcement in Ingersoll, and Windsor. They're trying to work that out. But it's been more to automotive. I'm not so sure about aluminum because there's not, yes, they're putting a tariff on it, but there's only some places. Canada, specifically Quebec, has some of the highest grade aluminum, so they don't really have, that much choice where else to purchase it from. Steel, again, I'm not really familiar with that market, but that's a bit of a problem. Yeah. But I don't think it's quite reflected in the job market.
It's indicative of
No. However, if they do need to stimulate the economy, if there's more job losses and they need to react, there is room for people. There's room for the bank to move, right?
No. Okay. So I get that. So then so that makes sense, because to me, I was thinking the opposite. I was thinking, okay, maybe the market, maybe it's not as bad as everybody thinks. But I guess alternatively, with what happened during COVID and the rates went so low and everything went through the roof, and there's a lot of people that are still sitting in homes with negative equity. How low is too low for them to drop the rates right now?
I don't think
they wouldn't go to 2%.
If it was catastrophic like COVID, where you had you needed that much stimulus in the economy, because there was we may not have been affected because we were actually busy, right? Yeah. You were busy, I was busy. But there are a lot of, especially smaller businesses, you have hair salon, hugely impacted, right? So those were rescue type rates. And I don't really, it wouldn't be in our lifetime that you would have seen rates that low. I think
we're not going to see that.
I don't think we're going to see that this time around.
So their overnight rates at 2.75. We might see that go down to 2.25. We're not going to.
There's a couple drops, but I don't think you're going to see rates go down to that level again.
Okay. So, and then I guess lastly, okay, because I know we're running on time, delinquencies. Okay, from COVID delinquencies. What are you seeing?
I know power of sales delinquencies have gone up.
Okay.
And now I know that there's programs being introduced by institutions right now for job losses. They're going to offer similar programs to capitalize mortgage payments, so you have some relief.
That's nice.
Right? So I do know that those programs, those similar types of I think they're going to be, they need to be stricter.
With the primary banks thing?
Yeah. I think they need to be stricter with the programs and not just, throw out money, because that created a whole other set of problems. So I think there has to be, more policy and some more rules around that, and not just throw it out there, because some people are having to pay some of that back now, right?
Yeah.
So who wants to do that?
I never want to pay money back,
right? So you'd want to. Those programs are there, and a lot of clients don't know this, but if you prepay your mortgage through times when they're good and you want to take some breaks, you can make arrangements to miss a payment and it's not going to affect you because you've built up that equity through prepayments.
That's kind of cool. That's
right?
really cool.
And there's some banks that have match a payment, miss a payment. So if you take them up on that program, so if you have a low mortgage payment, you're matching payments, you can miss some payments and it doesn't affect you. So there's lots of workout programs that are available, but the one key thing I would say to anyone is don't hide your head in sand. If there's a problem, call your broker, call your agent, don't ignore it. And that, like, I would say call the lender. And if you're not comfortable all mortgage agents have good relationship with lender. We can call our BDM and say, who should this person talk to? But talk to someone.
But are you seeing delinquencies up 20% or 50% or you know what I mean? Because like all the COVID money now, like this is the year that if you got a 4-year rate in 2020, this is 2025. You know, you would have come to fruition last year. But if you had a 5-year rate, you're 2025. So this is the year that most of those like 1.35 fixed mortgages are all coming due.
25, 26, some in 27.
So what's the expectations on that?
So they're going to have payment shock.
Yeah.
For sure, right? Because their rate is going to double. And you got to remember it has come down. It has come down, and the renewal rate is set at the mortgage balance you have now, not what it was. So you've paid down. Hopefully you've made hay, right? Because their interest rate was low. And then you have other options. If you really need to have a more accommodative payment, maybe look at refinancing. If you've incurred some debt, look at refinancing, extend that amortization back out to 30 years. Okay, it may not be what you wanted, but if it's the difference between, having to have a little bit of fun and not being house poor, then that could be the prudent thing to do.
Right. And because I always look at the market too as like if somebody bought a house in 2020, they still have their house would have gone up 50, 60%. And then it went down 25%. So they still have, 25 to 35% equity in their houses. So like, to me, when I look at that, I always say, okay, well, the worst thing they could do is sell, and then they're still making money, all right? So a lot of those ones, if they did have a 5-year fixed rate, they've still got positive equity in their home. Some of the people that bought at the end of 2021 and the beginning of 2022, a lot of those guys are the ones that are going to have trouble, which will be your 2026
right.
people coming through. So like the hardest part for them will be if they do have to sell. I always recommend if they have negative equity, stay in the house until they have positive equity, because you always need a place to live. But if you can't afford it and you sell, those are going to be the hardest hit.
Yeah, because at the end, the bank is going to want all.
Yeah.
Right?
Yeah. The bank always wants. They're greedy.
They're going to want every dime back.
Every single dime. They want your soul.
Right.
So, okay, just in closing here, tell us about, just quickly, how you feel the mortgage market is right now. Like, I know we've talked everything all about it, but in your professional experience, do you think it's a good time to get a mortgage? I don't want to blanket. It's always a good time. But like, how do you feel about what's happening?
Well, if you already have a mortgage and it's up for renewal, you have choices. And a mortgage is for a long time. You can look at a spot time, like maybe that rate in 2022 was the best time to get it because it's really low. But that mortgage isn't just for 5 years, right? The amortizations are 25, 30. And if you refinance, technically you could be paying off your mortgage for 50 years, right? Even because you refinance that many times. So a mortgage is for a long time. So you can't just look at it as if this is it and the rates are too high, I'm going to work, going to wait. If you're, for example, if you're renting and it makes sense and you have the ability to get into the market and it makes sense to get into, then I would say, yes, it's a good idea, because you don't want that hesitation to be in the way of progress.
Yeah.
Because unless there's something fundamentally changes in the supply of housing, which I know the government is planning on working on, but even if the election that happens on Monday and they announce, I don't know, some ridiculous number like 3 million new units in that's not going to come online in 3 months. That's going to take years, permits, right?
Yeah.
It's going to take a while to get those programs going. And so, if you are able to get in and it makes sense, and I just did a mortgage for a couple. They had a decent amount to put down and they bought a condo, but they were already living in a condo. And at the end of the day, even at their 4% range and with their down payment, once you take into account the condo fees and the taxes, they're basically maybe $300 less than what they're paying in rent.
Yeah.
So for that, you need to live somewhere. So I think it's a great idea.
And I think so too. Like, so I was looking at your app. Okay.
Oh yes,
earlier.
let's plug my app.
Okay,
Such
so
a good
Barb's
thing.
got an app. Okay, what's it called?
It's My Mortgage Center app.
My Mortgage Center app, and I've downloaded it as well. I know you guys can't see that, but I just took a home price of $800,000 with a 20% down payment, and it's uninsured mortgage. It's a fixed rate or variable rate at 3 years, 30 year amortization. The payment is $3,500 a month. Okay. The taxes extra are $260. Okay. So you're $3,750 roughly, $3,760 in a mortgage payment with your taxes for the same house. And I took a house that we currently have listed. For the same house, you would rent that for $3,200 a month. So you're anywhere between $500 and $700 more a month, and then you own a house. So if you do have two people coming together, okay, regardless if they're married or not, the affordability is great. But then, like you said, in 5 years, they're paying down their equity. So it is a benefit for someone to, like, still, even right now, the rates they are with certain properties, for someone to purchase versus rent if you can afford it.
Right. And then there's other creative solutions like an in-law suite with a separate entrance.
Yeah.
Right. I think that's going to be a huge trend going forward.
I'm doing this on $1 million. And on $1 million, it's $43,990 plus your taxes. Mm-hmm. So it would still, so on $1 million home, you might not be renting it the same, but you're still probably $3,500, $3,600 a month. So maybe a little bit more, but you'd be about $1,000 bucks.
Right. But let's say that house has the capability. Let's say it's a bungalow where you can have a separate entrance above grade windows.
Yeah.
And you can construct it's a whole nother podcast, Purchase Plus, construct a unit.
$1,800 a month. Yeah.
So off, right? There are creative solutions and there are financing programs available to help you get there.
Okay. And then just as we finish, it's funny because there's so much stuff we can talk about. We're going to have Barb back here. But just so we finish here, what do you say to the young homeowners out there right now that are like, I will never own a home? Like, everything's too high. I'll never own a home.
So I think you have to start somewhere with education, right? To at least prepare. I don't think one should assume that never is the answer, because they're, maybe it will take mom and dad if they're able to help, right?
Yeah.
Maybe they need to help. Maybe you start, with something smaller, a condo
expectations.
fee. Right. Manage your expectations. But, and that's our job to, I guess the best phrase is, I want you to love your budget, your mortgage budget, before you love that home. So we want to fall in love with the budget that we're proposing before you go out and find something and then we have to scale it back. Mm-hmm. When it would be much better if you love the payment plan and what we think the projected expenses are, and then you go find a home that fits that budget that you love. So fall in love with your payment before you fall in love with the house. And then you won't be so sad. It'll be happy.
And I would say the opposite. I'm just kidding. So I think that's important. So for everybody out there are alternatives. And I think one of the most important things is, too, it's like a lot of people have a tendency just to go online and say, hey, here's my payments. I'll never be able to afford a home. Or here's what the down payment is. I'll never be able to save up that money. Getting in the office. Some of the best things that I've ever done for my client base is, like, everybody thinks you never have enough time. Like, I've got time, set a meeting, come into the office, same as Barb, or she's a mobile mortgage specialist. She will come to you, even better, And then you can sit down and go through the numbers. Bank of mom and dad makes sense too. And there are ways to structure real estate contracts where mom and dad don't lose that money, and that money is equity in the house that could still make them money too. So for anybody out there, just think of that. Guys, I hope you enjoyed this. We've got Barb here. Barb Legerre. We are going to have her here on again because we have so many more notes to talk about. But it's been, Barb, thank you. It's been great, and it's been very educational.
Thank you. Thanks for the opportunity.